Good, so this will be the dry bulk panel, as you can see. There is a fantastic panel here on my right. I will make this your PM coffee after the lunch. Some are tired, but dry bulk is actually fascinating, multidimensional, and I hope that the people here will clarify the picture. So first of all, let me introduce the panel. We have the first to start with Mr. bin Battal. He is the president of Bahri Dry Bulk, and of course, which is one of the major companies in Saudi Arabia for dry bulk. They're transporting any commodity from grains, coal, iron ore to barley. And we're very glad to have him here, a lot of experience. His bio is on the website, it's quite impressive. Mr. Delaportas, Costas has been driving DryDel for a number of years. It's an owning and operating company. So he's going to give, he has a little bit of two hats today. Mark Filanowski from Pangaea Logistics. It's a NASDAQ listed company, so it's going to be good to have someone with the stock listing hat on to see a little bit what is his take on a few issues we're going to raise. And then Peter Weernink, for those of you who are not familiar, one of the most successful shipping traders and executives in the dry bulk market. He was formed in Cargill and then founded SwissMarine in 2001, SwissMarine being one of the leading dry bulk operators in the market. Good. I have a few slides on the dry bulk sector. As usual, I did it last year. I will be very brief, but I thought it was interesting to put a few slides of IFCHOR GALBRAITHS research. That's the team, which I'm very thankful to. 5 people very dedicated, even yesterday evening late, providing information to me for today. I'm going to just put that slide. That essentially sums it up for us. We, every month, the managers of IG and the research do a little bit of a meeting to provide our bull flags and bear flags and our opinions on the market. The research, of course, then formats it in a way that can be interesting for the audience and with the data that we have. So I hope this is going to be interesting for you to see. Obviously, the market is not a one-way street. It is difficult to predict and has been very difficult to predict in the last years because of the major disruptions that there have been and the various macro elements that have been coming in the way. So here you have a little bit of a summary. So in a nutshell, at IG we remain with a cautiously positive outlook for the years to come. I was positive last year. I think we got it more or less right. Of course, we had a bit of volatility. The smaller sizes have been more resilient than what we even thought. And probably the divergence I was speaking about last year between Capes and the other assets might come in more fashion in the coming 2 or 3 years because the flows are quite supportive of that. Now, with this having been said, and leaving you to read the bull and the bear flags that we have highlighted, I will start with a few questions for the panel. Of course, we're under time constraint, and I got a big clock here. Being Italian, Nicholas doesn't want me to be late. So I'll do as fast as I can, and I'll let you as much time as possible to speak. So the first question is for Mohammed, if you don't mind. From your perspective, how do you see the global economic trends shaping the dry bulk, let's say, in the next 2 or 3 years?
Yeah, thank you very much, Manu, and also glad to be here. Well, for the demand, the classical is China is the demand engine with, all dry bulk related, whether energy, food, or construction. Nowadays, we have seen more and more, including your slide here, a single-digit growth. So that means relying only on China as a demand will make us vulnerable to the ups and downs of the market. The good news, other origins are emerging. For us in the Middle East, with the transformation that going on mega project, that creating another demand. We're also looking at other origin, like in Southeast Asia, to look at demand holistically rather than the classical one route in and out China. Thank you.
Thanks for this reply. Now, question for Costas, because DryDel has committed a series of new building in Japan. and conventional fuels. What is it that pushed you in that direction? And how do you see that vessel positioning strategically for the years to come? What prompted you to that decision?
First of all, I would like to thank you very much, Mr. Bornazo, for your invitation here. I'm being honored to be here together with you. I hope the audience will enjoy our conversation, and it's good to bring shipping back to London, because this is very important stuff to see shipping people sitting here in London. Now, back 2020, I decided to move on the new building sector only for two reasons. The specifications were very competitive at that time. The fuel consumption was much less, and the prices that time was almost 30% from what is used to be here. So during COVID time, and I didn't lost my time, I decided to go to make this big investment, and we ordered 10 new building ships in the Japanese shipyards. We decided to move on the Handymax. This is the new handy size, which now, instead of 38, we moved to 41, 42,000 tons, and to 66, the new Ultramax size. These ships, by now, we have already took out of 10, 5 ships, the 4 Namura 40,000 tons. It's amazing. The consumption, you cannot believe it. Sometimes my operating office, we mix the consumption with the speed. We go 12 at 12. It's a longer carriers, and we fix those kind of ships 3,000 to 4,000 above the market level. So I think it was a very good opportunity for me at that time to build such quality ships. Now, from now on, I will continue building new building in Japan, only for the dry, because these ships are state-of-art ships. They are very important, and you are very efficient in the market trading this kind of ships. 6 months ago, we decided to move to a new sector. We ended on the Cape market, again, as usual, to Japanese shipyard. And we are newcomers on the Capes. We just ordered 2 ships, and we are looking more to buy more. The company DryDel will continue investing on new building because this is the future. Now, for the fuel, as you correctly say, for the dual engines, conventional, I am a conventional guy. I believe conventional will remain for the next 10 years because there is no clarity what fuel we are going to use. So instead of now spending 10 million to have a dual fuel engine for the new buildings, I prefer to keep building conventional fuel, which are the greener vessels in the today market. 12 at 12, it says everything. Thank you very much.
Thanks, Costas. One question for Mark now. Pangaea is quite diversified, though I would say operating mainly as well in the geared segment. Can you tell us a little bit more what commodities do you think will be a solid anchor for the geared segment?
Thanks, Manu. We have a pretty diverse fleet. We've got we own 40 ships. We operate about 75 ships every day through adding on to our own fleet through short-term charters in. Mostly in the geared segment. The non-geared segment, we have a range from post-Panamax to Panamax, and a large portion of that segment is contracted out under 10-year COAs to carry iron ore from the northeastern part of Canada in the summer, because the ports are all closed for 8 or 9 months during the year, even for our ice-class ships. And we also have a contract that starts in 2026 with iron ore into the Baltic. 3 of our other Panamaxes are operated in a shuttle service, full-time, taking bauxite out of Jamaica into New Orleans to feed the U.S.'s last remaining alumina refinery. So, to a great extent, we're fixed on our non-geared segments on contracts of affreightment or other business that is long-term. There are occasions when we're in the spot market for efficiencies. We do other business, and what we've done is to take opportunity to take some of our sister ship Panamaxes that were built in 2014 to 16 in Japan. When they're coming up for their 10th surveys now, we're recoding their cargo holds, something I didn't think we'd ever do, but we've done it to add flexibility to that fleet keep it moving in other ways. Is that's really the basis of our business, it's flexibility.
Thanks, Mark. Question for Peter now to go in the order close to me. So, Peter, what do you think for the coming few years? Are we going in a structurally stronger cycle for the dry bulk, or do you think that the supply, particularly on the smaller sizes, will put a bit of a cap on this market?
It depends what you structurally mean with how many years is that?
3 to 5?
Okay, next 1-2 years, our numbers have the market tightening gradually, but not to such an extent that events can't upset that. Looking a bit for 3 to 5 years out, obviously we have a huge number of ships built 2008 to 2012, which getting to a certain stage, and in the dry bulk that is the big question mark, what happens there, because obviously the yard capacity is no longer there to build that kind of, to replace that kind of fleet. So in principle, the picture looks healthy.
Fair enough. Thank you for this.
But there's also another side to that. Actually, to add, on the other hand, the big thing in the last 20 years has been China. And to me, China is ex-growth. Yeah? Still looks okay. The orders are, it looks okay, but it's not a no-brainer.
Thanks. Maybe we'll catch up also on China later on, which of course is a crucial element for the dry bulk. Now, question from Mohammed again. Bahri, you're balancing a little bit your exposure to the different dry bulk commodities. Where do you see particular challenges or growth opportunities, given also your essentially your core business?
Yeah, well, for us, I mean, as Bahri at large, we are diversifying the portfolio, whether in the tankers, liner, as well as dry bulk, and very soon perhaps even some gas activities. When it comes to the dry bulk in particular, we have a very unique position. So we are not a classical ship owner, so attached to the ship 100%, nor an operator with the cargo. So we try to pivot around something in between that always pivot around the national cargoes in and out from the kingdom. There is a certain extent to diversify, I mean, in terms of the different commodities. But at the end of the day, we ride the cycle and the roller coaster. What we are trying to do is to minimize the troughs and peaks on the long run.
Clear. Now, a question for the other 3 members of this panel, because I would like to spark a bit of debate here. I remember we were at the conference before, Peter, and there was a big question about coal. Coal has been dying, then resurrecting, then dying, then resurrecting. So now imports have been, or generally the flows have been falling down this year quite abruptly. It was a negative ton-mile for 25 and still will be. However, we probably see some light for 26. Is this, you think, I mean, is this a structural decline or just a temporary dying and then resurrection for the next couple of years to come?
I think this pause on the...
No.
Okay.
You can all go.
I think the pause on the coal, I think is a bit seasonal, because always on the first half, on 2025, we have less coal consumption, but on the second half, due to the summer season, we burn more coal. I think on the short terms, we see a bit on the pricing coming down, but of the medium and the long term, definitely the coal will be there. Actually, we need a lot of coal, we need a lot of energy. As you know now, the AI, with the new data center, we need a massive coal, we need massive energy. Cannot be replaced by green energy or any solar panels. So I'm sure that we need a coal. The coal will be there for many years, and I don't believe it will be out, will be reduced. We need to wait to see the result for the second half 2025, and we see that it's picking up. That's why the dry market is increasing. We see a lot of shipments coming coal. On another factor is the electric cars. Most of the people using electric cars. In the night, everybody goes at home. We put energy from the coal. So I think it will remain very solid for the next couple of years. Cool.
Peter, what do you think?
Yeah, I paint a different picture, of course. I stuck out my neck earlier. I said, okay, no, I think we've seen the high on seaborne coal, which of course is slightly different issue than Costas talks about. Seaborne coal, to me, odds are has peaked. About 49% of seaborne coal is China, India. It's a small part of those markets. There's a lot of coal in China and India. And there's a lot of growth of renewables, particularly in China. So the odds to us, and what our coal customers tell us, they have next year down in volumes. I notice you have it up in your first slide. We have coal volumes again down next year. There's other things, and coal is quite relevant in the sense that if you talk the commodity which adjusts in size depending on where market levels are, there's coal. Coal in Panamax is actually up this year, whereas coal in Capes is down a fair bit. Especially if you look at the outlook for Capes, and yes, indeed for Capes next few years versus smaller sizes being quite different, then the relevance is that the odds are that more coal will continue to move in smaller sizes. You mentioned that, yes, in July, August, we had a substantial uptick in coal, but that has more to do with rain in North China and in heat waves in south of China, and in therefore additional airco demand. But to me, that's temporary blip. Doesn't mean over the next few years you can't have an up year again. Yeah, but you have to realize the seaborne coal is a small balancing number in the Indian and Chinese market. The rest of the world coal, all the countries are relatively small, even though we see growth, South Asia, I agree, but it's relatively small. So the odds still are that coal volumes have seen the high. I maintain that bet.
Good. And Mark, as an Atlantic-based operator and owner, how do you see, first of all, how much coal do you transport in your fleet roughly? And how do you see the coal element in dry bulk in the coming years?
Since our contracts are mostly iron ore or bauxite, we don't carry a lot of coal. It's pretty much spot and opportunistic, but I guess I'd say maybe 10% of the capacity of those ships. I agree with Costas that there's a huge demand for energy and energy derived from coal, because there's going to be a lot of coal there for a long time to burn. But I'm not sure I would invest in coal-carrying ships.
Fair enough. That seems to me a pretty balanced view here from the panel. So, Mohammed, can we go back to the question of disruptions in dry bulk? I think in the last 2 years we have seen so many disruptions and complications. How are you, as Bahri Dry Bulk, navigating this, especially given your geographical position?
Yeah, well, I mean, for dry bulk, earlier we had the Black Sea situation, which dry bulk were very impacted. Then, again, the droughts, whether in the Panama Canal the other day, and most recently the Red Sea, which is a major waterway globally, and for us, in the kingdom, to access all the Red Sea. How to navigate it? We have the multimodalities in Bahri, so we do have, although the name in Arabic means seas, but we are big in logistics, whether it is air freight, whether it is ground logistic, storage. But that doesn't mean we can rely on it, especially on massive quantity and ocean going. So we continue to create resilience without jeopardizing the safety of our seafarer, the integrity of our ship. But so far, knocks the wood, we have been able to navigate all terminal water, I would say.
Well, thanks for that. Now, Pangaea, SwissMarine, DryDel, you're all operating in the market. You're not only owner or charter or... So you have two hats, but in different business models, I would say. So can you tell us a bit more how that has been evolving for you? what kind of side of the business model you wish to push forward in the coming years, because you think it's protective of the business and it's accretive to the business. So maybe starting with Costas, these two hats, how does it add to you, to the company?
Okay. Actually, I have decided back 2010 to move to a different structure rather than a typical Greek shipping company. You know, people in Greece were not so much operating, but by 2010 I decided to move in Singapore in order to do my first operating office in Singapore. Now, DryDel, we have 5 offices. We have Dubai, Singapore, Sao Paulo, Brazil, and we just opened in Houston. For me, the very important aspect in the dry market, I always keep saying that the cargo is the king. You need to be, if you want to expand a lot, you need to be together with the cargo owners. This is a very special relationship which most of the Greeks they haven't understood it till now. I'm doing one of more successful operating offices in Greece with my 5 satellite offices, but we need to know that you have to have excellent relationship with the cargo owners. Cargo is the king on the dry.
Thanks for this. Mark, you want to add to that? I mean, your model is, of course, a lot of COAs, long-term coverage as well on part of the fleet. How do you see that, and how have you seen it evolving in the last years and for the years to come?
Cargo is a story for us as well, Costas. It's always been there. It's always been our first emphasis. In fact, when the company was established back in 1995, the company had no ships. So until I think 2004, it didn't have any ships. But as the company grew, it became necessary to own ships, but not own all your ships. So we go out, we try to find cargo, and then we decide how to assign our fleet, whether it's an owned ship or a chartered ship, doesn't make any difference to us, but the chartered-in ships add efficiencies to the owned ships. And it's all done with the emphasis on protecting the bottom, to try to keep some cargo on the books all the time so you can keep your own fleet employed. And when we charter in on a short-term basis, so that's the relief valve. If the market goes against us, we can let those ships back into the market. We've also tried to expand our presence in the supply chain with our customers. So we do stevedoring onto the ships of cargo. We do stevedoring off the ships. We store cargo. We deliver cargo on trucks to our customers. We operate in 10 different ports in the southeast coast of the U.S. and U.S. Gulf. So that's another way to not only expand your customer base and your cargo base, because we can offer our customers a more fully developed transportation offering, because we can put it on, we can transport it by ship, we can take it off and deliver it to their port or their plant. It also expands the whole business. It provides more revenues, more information from the market, and more EBITDA.
Clear, thanks. Peter, just to tweak a bit the question, you've been operating since 2001, and you essentially have been the operator by definition. And how have you seen, risk management and trading techniques changing in the last, I would say, years, the last 10 years, 5 years?
Oh, that's a tough one. I wasn't ready for that one.
Without telling us your strategy for the years to come.
Well, a lot of things we tended to do early on. What amazes me always is the ways we looked at the market 10, 20 years ago, I now see has become pretty commonplace, right? The way you price ships, the way you price front haul versus back haul, all that has become very common space. So you can't make a difference with that anymore. What that means is we have to keep focusing on what we are good at. We're at a different place now. We run 170 ships. We run a very large, quite balanced book, and that book gives us a fair bit of information. So we have to trade around that. I noticed the subject digitalization. We'll get to that later. Not convinced. We've tried a lot. Not convinced that brings us so much. What we see recently is that in the Capesize, we struggle to grow much. We will keep doing it. We love it. It's a core of our business, but we don't see much room to grow. We see more room to grow in smaller sizes, so we've built that up. We do more long-term charters. We do a bit more ship owning. We invest in other teams like summit trading and some other things we're doing. We invest more in financial markets. So we try to broaden the perspective of what we do in order to grow the market and use the tools we have today, which we didn't have 10, 20 years ago.
Clear. Now, going back to a topic which is China, and we have been quite specific for the moment, really on dry bulk and business models. So for the people in the audience in finance and banking or shipping lawyers, it's maybe time to go back to a little bit the core fundamentals of this market. So, as I said before, we believe that the ore flows will improve in the coming years. There has been quite a lot of publicity around new projects coming on stream end of this year, next year. So we expect that to grow. Now the question is, and this is a question for the panel that maybe we can take in sequence, how do you feel China will absorb that more abundant supply of iron ore, bauxite, because that could also be an oversupply trap because China doesn't have the capacity of absorbing that. How do you see that? Maybe we can start with Mohammed. And Mohammed, your core is also the grains, so you can also talk about probably the grains. The grains are, of course, very accretive to the smaller sizes, so maybe give us your opinion a little bit on the whole picture, if you like.
Yeah, no problem. Well, I mean, for the iron ore, historically it goes two ways. I mean, the construction in China, whenever they have a stimulus package, they put it in more housing, urbanization, as well as the finished product that they have to export. Today, both are under some pressure. I mean, given now the more and more the stimulus packages to award high-tech and other activities, and the export with the tariff situation is also a little bit impacted. But on the long run, I mean, my personal view, a lot of refurbish activities on the infrastructure going forward globally, a lot of more goods to come. So I believe, I mean, between iron ore as well as bauxite and aluminum, I mean, China will be able to have a good share out of it. Grain will go along to, I mean, feed the population growth both there and as well as in India.
Of course. Good. Costas, what's your view?
My view is that China will continue consuming iron ore. Now we have the new project, especially on the Capes, the new Simandou project from West Coast Africa. And I think they are planning to ship almost 120 million metric tons annually basis. I think this type of iron ore has a very good quality, is a high-grade quality of iron ore, of content more than 65%. The price is very competitive, so I think this will increase the toll mile, especially for the iron ore. Now for the bauxite cargo, as you know that we have the Guinea, also very competitive price, better quality, and Chinese are moving now from more longer distance to import the two major commodities. So I think especially on the gearless tonnage on the Capes, we'll see a very good market which is coming. On the Cape now, as you know, more than 40% of the existing fleet now is more than 15, 16 years old. Very few shipyards on the Capes are building ships, only very few in China, only 1, 2 in Japan. So I think there is a value now to invest also on Capes because of these two cargos and commodities.
Mark, views on iron ore, bauxite? You're a player there in those commodities. And China, what's your view?
Well, iron ore and bauxite, I think, are both pretty strong and will remain strong overall worldwide trade. China, I think, will, and they have to keep producing, either whether for internal consumption or external export of finished goods. They'll keep producing, and they'll have a need for iron ore and bauxite. and many other minerals.
Okay. So three relatively positive views. So I'm curious to hear what Peter has to say on China.
Okay. So I will disagree.
Disagree.
Of course. To me, China, big picture, right? And we're not talking specific years, but just big picture. China's ex-growth. The story the last 20 years has been Chinese growth. To me, that's done. Doesn't mean we won't have bits up and bits down and the different pictures per commodity, but big picture, ex-growth. That's not where it's going to be. I think the next 10 years, whereas the last 20 years, all we talked about is supply side. All we had to look at how much new mining capacity is available, it's going to be moved. To me, the next 10 years, we will be looking at demand again and at fluctuations in demand. Now, obviously, by commodity pictures are slightly different. Yes, we have 70 million ton more iron ore next year. We believe it's going to be shipped. We also believe Chinese steel is not growing, so it will, to a large extent, replace other origins, maybe replace different sizes. But yes, 60 of the 70 million tons we have in our model is ex-Atlantic, so it's long distance. Iron ore. Guinea, yes, bauxite has more room, but in theory, there's a cap, hard cap of the amount of aluminium capacity in China, which gives some more room for growth, but not as much as this year. And in theory, that stops at a certain point. Obviously, aluminium prices are moving up, so everything can change over time, but looks different. On the grain side, my grain friends from the trading world tell me that the big picture is it's China ex-growth, or not growing as much than supply is growing. So demand is going to matter more going forward.
Clear. Well, pretty good to me. So now, moving a little bit into other spaces, I mean, USDR has been a big thing for all of us, brokers included. Of course, figuring out the exact consequences and so on. Now, with its imminence of implementation, as it seems, what is, how are you managing that? Maybe we can do a quick reply for each of you on how you're managing that, how are you envisaging, how are the teams working on it to avoid particular exposure to USDR or managing it simply. Maybe we can start with Mohammed again.
Well, for us, I mean, we have at the bigger picture of Bahri, we have some exposure. For the dry bulk, we don't have any exposure within the fleet. Management, the diversity of the fleet, then you need, I mean, to have it part of your arbitrage game at the end of the day.
Clear. Costas, view you're operating more and you're chartering in and so on. How are the teams working around the USDR problem? Not as an owner, because you're Japanese, essentially, built.
Actually, this is a very good question. I was having a meeting today and say, Mr. Trump, did you know that, did you get the information of Mr. Trump? Because all my ships are Japanese, all my time charter ships, which now we are having 28 on the long TC period, are only from Japan. So it doesn't affect to me at all. All my ships are Japan, the time charter trips are Japanese, so I don't have any issue. But now what we see in the market, we will see with this the USDR, it will bring a lot of congestion. A lot of Chinese operators and Chinese owners, they will move out from the US Gulf, from US East Coast, West Coast, and they will go all the ships to take the grains from East Coast of America. So I think this will create a congestion in the market. Out of my 40 ships, which we are controlling now, with my own ships and the time charter in ships, when we go to East Coast of America, we see 10 to 20 days delay. This will grow more by November when this implementation comes. So I think that China, which are huge ships, big operators with grains, they will have to send the ships only in East Coast South America. This will gives massive congestion in these ports. And that's why we see the markets picking up. For the last 2 or 3 months, we see on the dry sector, the market pick up already 30% as it used to be.
Yeah, and I would say Atlantic driven mostly, yeah, you're right.
And Chinese, they don't go anymore. They are a bit worried. Even the Chinese leasing, if there's a Chinese leasing behind, also there's an issue on that. So all these ships, they will have to go only from East Coast South America.
Mark, what's your experience at the moment with USDR? I mean, you come right from the US. So tell us.
When the USDR was first announced, we said, wait a minute, this wasn't meant for us. You know, we've got 17 ships that are built in China, and we weren't supposed to be affected here. But people went to work in Washington and explained the situation, retargeted, refocused the efforts, and today we've got 4 ships, 4 post-Panamaxes that were built in China, which doesn't give us a real problem, but they're owned by a Chinese lessor. Purchase options come up next year, so if we see a need, we will buy those ships and refinance them. Doesn't really impact our operation today because those ships don't visit the U.S. a lot. On the chartered-in side, on the operating side, yeah, it's caused a little confusion. We're looking for protection from charterers or owners of ships were chartered in, that they don't have Chinese beneficiaries in the line somewhere, appropriate charter party clauses, but we're pretty much staying away from Chinese-built or Chinese-operated ships if the business is going to be in the U.S. Again, we do short-term business, so we can predict that pretty closely. But there seems to be some kind of movement of Chinese-controlled ships, if you want to call them that, away from the Atlantic. Yeah.
Clear. Peter, USDR?
What we see currently, there's 2 main effects, which we think fairly realistic. Part of the fleet can't trade US, so it will make the allocation of ships, cargoes, slightly less optimal. So in that sense, it will be marginally positive for the market. Secondly, as you have part of the fleet which can't trade to the US, if you have a demand surge from the US for some reason, some seasonal reason, or something happens, then only part of the fleet can react. So I would think the odds are that it increases volatility.
Clear. Thanks for that. We have 3 minutes, 36 seconds left, Niklas. I'm being very careful. So I'm going to ask a quick one, a last one, where you essentially have to determine yourself and give a straight reply. So, if you have to look at your companies, by 2035, and you have to, let's say, imagine those companies in 2035 according to 3 main elements. One is scale, one is carbon neutrality, and one is, let's say, good risk management and disciplined returns. If you had to prioritize 2 out of these 3, and of course you have different companies' backgrounds, so you're probably dictated by that, but I would like to hear maybe from Mohammed. So scale, carbon neutrality, or risk management and disciplined returns?
Yeah, I mean, they are all equally important. Well, for us, I mean, we are engaged in a localization program that is mandating us to grow. So I would look into scale in all aspects. The localization is meant to create resilience. So definitely the risk of the supply chain itself, as well as balancing the return, because also at the end of the day, we at Bahri are a publicly listed company, so we need to manage the returns in the long run also for the shareholders.
Fair enough. So you're going to try to go after the Holy Trinity, the 3 of them, in a way.
And more, beyond the 3.
Beyond. Costas?
I will definitely choose the disciplined returns because for me it's very important to have a strong balance sheet, to have a low leverage, and to work as a boutique service, not such a big supermarket. So this is my strategy for my company. We don't want to grow a lot. We like to remain on this level because there is a lot of uncertainty in the market, as Mark says and Peter said. So I think for the next 5 to 10 years, I think that it's better to work as a boutique service.
Thanks. Mark, scale, carbon neutrality, risk management?
I'd say scale is important for a public company, of course, but it's also going to become more important, as Hamish Norton said this morning, to be able to comply with all the regulations coming down and to get into the more modern, more, I guess, smart shipping company mode. Carbon is going to be required, so I wouldn't address that right now.
Yeah, fair enough.
But risk, your question about risk brings me back to just last week when I got out of business school. I was writing this paper for our board of directors on some crazy business I was trying to do in East Coast India, and I said, well, the directors are going to want to know what the risks are and what we're going to do to manage them. And I started writing, and I kept on writing and writing and writing. And there are so many risks that we all face every day in every transaction, every fixture we make, every ship we charter in. It's incredible that there are so many risks, and the secret to success is correctly understanding them and managing them.
Thank you. Peter?
Well, to have a right to exist and to be useful to our customers, risk-adjusted returns and scale are essential. Otherwise, we don't exist. However, I'm totally convinced that 10 years from now, we will again be using or producing substantially less CO2 per ton mile we deliver. That's a trend that's irreversible. That's going to continue happening.
Thanks. Well, I think we're 20 seconds over time. Sorry, Nicholas. On behalf of IG, wish to thank you for inviting me moderating this panel. Wish to thank the panelists because their opinion really matters and mattered today. So I hope you enjoyed this dry bulk panel within today's great panels of finance and other segments, which we're going to follow soon. So thank you very much. I think a big applause for the panel.
Thank you.